Ever imagine a world where computers are calling the shots, picking stocks and currencies and commodities and making money whether the market's up or down? Well, that world exists, and it was largely shaped by a guy named Cliff Asness. As of July 2024, his net worth was estimated to be $2 billion. Not bad, right? Now, you might think someone like Asness would be a Wall Street whiz kid from the start, but his path was a little different. Born in 1966, he actually started as an academic, earning a PhD in finance in 1994. But those market sirens were calling, and he couldn't resist. Asness landed at Goldman Sachs in the 1990s, where he managed their quantitative research desk. Now, this is where things get really interesting. He was essentially using complex computer models to find investment opportunities. Think algorithms sifting through mountains of data to uncover those hidden gems. But Asness didn't stay at Goldman Sachs for long. In 1998, he took a leap and co-founded AQR Capital Management. This company would become a giant in the hedge fund world, managing a staggering $33 billion by 2010. Now, here's something you might not expect. While Asness is known for his quantitative approach, he's also been a pretty vocal critic of the financial industry, especially those hefty hedge fund fees. He's argued for greater transparency and even spoke out against short-selling restrictions during the 2008 financial crisis. A guy who's not afraid to, rock the boat a bit. And Asness doesn't shy away from expressing his political views either. He's criticized certain government policies, even having a very public disagreement with former President Barack Obama about the way the Chrysler bailout was handled. So let's rewind a bit and look at Asness's early life. He was born in Queens, New York, to a family with an interesting mix of backgrounds. His mother, Carol, ran a medical education company. His father, Barry, a former Golden Gloves boxer who later worked as an assistant district attorney in Manhattan. Talk about a unique combination. When Asness was just 4 years old, the family moved to Roslyn Heights, New York. He went to camp, attended Herrick's High School, and eventually ended up at the University of Pennsylvania. Here's where his academic excellence really shined. He graduated summa cum laude in 1988 with not one but 2 bachelor's degrees. He double majored in computer science and finance as part of the Jerome Fisher program in management and technology, also known as M&T. You can already see the foundation for his future career taking shape, right? The blend of finance and computer science is pretty telling. And it was during his time at the Wharton School that his fascination with finance and portfolio management really took off. He even worked as a research assistant in the finance department, learning how to use those coding computer programs to analyze markets and put those economic and financial theories to the test. But Asness didn't stop there. Next stop, the University of Chicago Booth School of Business. By 1994, he'd earned his MBA with high honors and, to top it off, a PhD in finance. Now, while at Chicago, Asness rubbed shoulders with some of the biggest names in economics. He was a teaching assistant for none other than Nobel laureate Eugene Fama, who was also his dissertation advisor, a mentor. He also worked with economist Kenneth French. Both Fama and French were renowned for their work in empirical financial economics. In fact, they had developed the influential Fama-French three-factor model back in 1992. This model built on the capital asset pricing model by adding in 2 key factors, size and value. He would go on to play a major role in shaping Asness's approach to investing. It's all about understanding the different forces that drive market returns. Asness's doctoral dissertation itself focused on momentum trading, the idea of buying stocks that are experiencing rising prices. His research suggested that you could actually beat market averages by taking advantage of both value and momentum. These ideas weren't brand new, but Asness was the first to gather a ton of evidence across lots of different markets to prove their validity. So picture this. It's the early 1990s, and Asness is armed with a PhD and a head full of innovative ideas about how to make money in the market. But here's where he made a decision that might surprise you. He left academia and dove headfirst into that fast-paced, high-stakes world of Wall Street. His first stop, Goldman Sachs Asset Management, or GSAM. It's there that he made his mark as the manager of their new quantitative research desk. And he didn't go alone. Asness brought along 2 friends from his University of Chicago days. Together, they set out on a mission to develop models to evaluate risk in currencies, bonds, and entire economies. This was groundbreaking stuff that would set the stage for Asness's future success. It was during this time in the late 1990s that the idea of factors, championed by Fama and French, really started to take shape. Asness and his team at GSAM took those insights and combined them with the knowledge Asness had gained during his PhD research. They were creating a new way of looking at investments. Now, here's a bold move. In 1995, at the ripe old age of 24, and while still working on his PhD, Asness convinced a few partners at Goldman Sachs to invest $10 million in his vision, his goal, to use those computer-driven models his team had developed to make a splash in the market. And make a splash they did. His models proved to be incredibly successful. When that initial $10 million investment grew to a whopping $100 million, Goldman Sachs decided to open the fund to the public. This was the birth of the Goldman Sachs Global Alpha Fund, one of the earliest quant vehicles in the industry. Global Alpha, a systematic trading hedge fund, quickly became known for its use of high-frequency trading. It played a key role in the rise of both Asness and his colleague, Mark Carhart, who would both become major figures in the world of finance. Asness and his team at Global Alpha used these super sophisticated computerized trading models to identify undervalued assets across a whole bunch of markets: equities, bonds, currencies, you name it. They even traded commodities. And once they spotted an opportunity, they used short selling to capitalize on the price momentum, whether it was going up or down. The goal was to make money no matter which way the market was moving. Fast forward to 2006, Global Alpha was a major success story for Goldman Sachs. The Wall Street Journal even called Asness and Carhart gurus who managed this big secretive hedge fund. They called it the Cadillac of a fleet of alternative investments that had brought in millions for the financial giant. Global Alpha hit its peak in 2007, becoming one of the biggest and best-performing hedge funds in the world. At that time, it had over $12 billion in assets under management. Pretty impressive, right? But then came the 2007-2008 financial crisis, and Global Alpha, like many others, faced significant challenges. It ultimately closed its doors in the fall of 2011. But that wasn't the end of Asness's entrepreneurial journey. Remember, he'd co-founded Applied Quantitative Research, AQR Capital Management, back in 1998, while still at Goldman Sachs. This quantitative hedge fund firm would become his main focus in the years to come. And AQR, it was a success. In 2002, his compensation at AQR reached $37 million, and by 2003, it had climbed to $50 million. In 2004, AQR moved its headquarters from the hustle and bustle of New York City to Greenwich, Connecticut. Now, even AQR, with all its sophisticated models and data-driven strategies, wasn't immune to the 2007-2008 financial crisis. The company did report losses during that time, but AQR bounced back. By the end of 2010, it had $33 billion in assets under management. A 2010 Bloomberg article described AQR as a quantitative investment firm that used algorithms and computerized models to trade. They were all about making data-driven decisions. So AQR is doing well, and the state of Connecticut takes notice. In 2016, the Connecticut State Bond Commission decided to give AQR a helping hand, a $35 million financial aid package to encourage them to, stay in the state. This is part of a larger effort to keep businesses, including the hedge fund giant Bridgewater Associates, in Connecticut. That aid package included a $28 million loan that would be forgiven if AQR kept its existing 540 jobs in Connecticut and created 600 new ones by 2021. Plus, AQR received $7 million in grants to help with its expansion plans in the state. But here's a shift in Asness's thinking. By 2017, according to Forbes, he started to kind of move away from those traditional hedge funds. He became a big advocate for lower-fee investment products that offered more liquidity and transparency, things like mutual funds. He wanted to make those sophisticated investment strategies that were often used by hedge funds accessible to a wider range of investors. By 2019, AQR had grown into a full-fledged investment firm operating one of the world's largest hedge funds, as The Economist put it. They were leveraging their expertise in factor-based investing, offering a diverse range of products from hedge funds to mutual funds to cater to all sorts of investors. In 2023, Asness, along with stable asset management and other institutional investors, poured hundreds of millions of dollars into a new multi-manager hedge fund called Niche Plus. This was the first fund from a company called Clear Alpha Technologies, and it marked a pretty interesting development in the hedge fund world. Niche Plus is managed by Brian Hurst, an AQR alum, and Elisha Weisel, the former chief information officer at Goldman Sachs. The fund focuses on niche strategies, including something called temperature arbitrage. Basically, they're looking for ways to profit from price differences in weather-related investments. It just goes to show you the constant innovation and specialization that's happening in the hedge fund industry. But Asness isn't just a numbers guy. He's also known for speaking his mind on economic and political issues. You'll often find him sharing his opinions in print, on CNBC, and other TV programs. He's been a vocal critic of those high hedge fund fees, particularly for funds that just track the stock market. He argues that there's no reason to pay those sky-high fees when you can get similar returns through, low-cost index funds. Back in 2008, during the financial crisis, Asness even wrote an op-ed for the New York Times to express his concerns about restrictions on short selling. He believed these restrictions could make the markets less efficient and potentially make the crisis even worse. In 2010, he teamed up with Aaron Brown to write another op-ed, this time for the Wall Street Journal. They criticized the Dodd-Frank financial reform bill, arguing that it could lead to regulatory capture. That's when regulatory agencies get too cozy with the industries they're supposed to be regulating. They worried that this would benefit insiders at the expense of the broader market. Asness has continued to speak out on all sorts of economic and policy issues. He's written about things like taxing investment managers and the complexities of healthcare reform in his columns for Bloomberg. He even has his own website called Stumbling on Truth, where he shares his thoughts on financial matters, often from a libertarian and efficient markets perspective. He's definitely not afraid to challenge conventional wisdom. One of the best examples of Asness's outspoken nature is his criticism of former President Barack Obama's handling of the auto industry bailout. In two separate articles, Asness has criticized the way the administration treated Chrysler's senior bondholders, arguing that it set a bad precedent and weakened the rule of law in financial markets. He's a guy who sticks to his principles. Now, before we wrap up our look at Cliff Asness, let's take a look at some of his key academic publications. These really highlight his analytical mind and his impact on the world of finance. One of the things that makes Asness stand out is his commitment to solid research and analysis. In 2001, he co-authored an article for the Journal of Portfolio Management that took a critical look at, hedge funds. He and his colleagues found that while some hedge fund managers were really good at picking stocks, not all of them used effective methods. This research was important because it showed that investors need to carefully evaluate hedge fund strategies and their performance. Instead of just assuming that all hedge funds are, superior, Asness continued to challenge conventional wisdom in his research. In 2003, he co-authored a paper with Robert Arnott for the Financial Analyst Journal. They challenged the common belief that companies paying higher dividends had lower earnings growth. Their research actually found the opposite. Companies with higher dividend payouts tended to have higher earnings growth. This finding had big implications for investors who were looking for both income and growth from their investments. That same year, 2003. Asness published another noteworthy paper in the Journal of Portfolio Management. This time he took aim at the Fed model, the popular but flawed way of comparing the stock market's price-to-earnings ratio to interest rates. Asness argued that this comparison didn't make sense and could, mislead investors. His critique of the Fed model helped raise awareness of its limitations and encouraged people to use more sophisticated methods for, valuing stocks. One of Asness's most influential academic contributions came in 2013, when he co-authored a paper with Tobias Moskowitz and Lasse Pedersen. This paper was published in the Journal of Finance and explored the relationship between value investing and momentum investing strategies across 8 different markets and asset classes. They found strong evidence that both value and momentum strategies could generate excess returns, no matter what market or asset class you looked at. This groundbreaking research cemented Asness's reputation as a top expert in quantitative investing. So, as you've seen, Cliff Asness's story is a testament to the power of intelligence and a willingness to challenge the status quo. He's not afraid to speak his mind, whether it's about hedge fund fees, government policies, or even academic theories. He's a true trailblazer in the world of quantitative investing, always looking for new ways to understand and navigate the complexities of the, financial markets. Asness's journey is a reminder that success is about more than just making money. It's about making a difference. It's about using your talents and your platform to push boundaries, spark debate, and make the world a better place. And on that note, we'll leave you with this thought. Could you create a computer program to beat the market? Something to think about, isn't it? Hit that subscribe button so you don't miss our next fascinating story. Until then, keep learning, keep exploring, and keep asking those big questions.